I want to show you something that should make every Forex trader uncomfortable. A trader named Marcus spent 4 months building a strategy. He tested it on 5 years of Eurodollar data. The backtest showed 10,247% return, Sharpe ratio of 3.8, maximum drawdown of only 4%. Every metric was perfect. Every number was exceptional. He had, by every measure, built the perfect system. He went live on the 1st of January with a $10,000 account. By February 1st, he had $1,800 left. The account lost 82% in 31 days. His strategy had not changed. His execution had not changed. The market had changed. And his strategy had never actually learned to handle it. What happened to Marcus happens to thousands of retail traders every year. And most of them never understand why. The answer is curve fitting, also called overfitting. And it is the most dangerous trap in all of systematic trading. I am going to show you exactly how it works, why it feels like real edge, and how to build strategies that actually survive the future. First, let us be clear about what backtesting actually is and what it is supposed to prove. And here's the question most traders never ask. Is the historical edge coming from something real or from noise? The assumption behind backtesting: if the edge existed in the past, something real caused it, and that cause still exists today. Real edges come from things like human psychology creating recurring patterns, institutional order flow leaving repeatable footprints, or volatility cycling in predictable ways. When the edge comes from something structural and persistent, the backtest captures it correctly. The problem is, backtesting also captures noise. And the human brain is extraordinarily good at mistaking noise for signal. Your pattern recognition system was built to find meaning in random data. It is one of the most powerful features of human intelligence. It is also one of the most dangerous in trading. Let me show you exactly how this plays out in a real example. Imagine you have a simple rule. Buy Eurodollar when the 20-period moving average crosses above the 50-period moving average. You run the backtest. The result is mediocre. 34% return over 5 years. Win rate of 48%. You are not satisfied, so you start adjusting the parameters. Maybe the 20 and 50 are not the right periods. Maybe 18 and 47 work better. You test that combination. You try 22 and 53. You try 15 and 45. You try 25 and 60. You test hundreds of combinations until you find the one that produced the highest return on this specific historical data set. And that is the exact moment when you cross the line from strategy development into curve fitting. You did not find a rule that explains why price moves. You found parameters that happen to work best on this particular piece of history. These are not the same thing. And the difference is the difference between a strategy that survives the future and one that collapses on day one. Here is the metaphor I want you to remember for this entire video. Imagine you are a tailor. You have been given a mannequin that represents the past 5 years of the Eurodollar market. You spend months crafting a suit. You measure every curve, every angle, every proportion of that mannequin with perfect precision. When you are finished, the suit fits the mannequin perfectly. Not a single wrinkle. Not a single gap. It is flawless. You look at this masterpiece and you think, this is the best suit I have ever made. Now a new customer walks in, not a mannequin, a real living person, the future market. They are a different shape, different proportions, not dramatically different, but different enough. You put the suit on them and it burst at the seams. Not because the suit was badly made, it was perfectly made for a different customer. Your strategy did not fail because you were wrong about trading. It failed because you were too right about the past. You fitted so precisely to history that it had no flexibility left for the future. This is curve fitting, and it is not a beginner mistake. It catches experienced traders, professional quants, and entire hedge funds. Let me show you the 3 most common ways curve fitting happens in retail Forex trading. Method 1. Parameter optimization without out-of-sample testing. This is the moving average example I just described. You keep adjusting the inputs until the historical result looks impressive. The statistical term for this is p-hacking. You are not testing a hypothesis, you are searching for a result. In research, a study that tests 20 different hypotheses and finds one significant result is not considered strong evidence. In trading, a strategy tested with 20 different parameter sets and selected based on which worked best is exactly the same problem. And the problem gets significantly worse as you add more parameters to your strategy. A strategy with 2 parameters requires only a few combinations. A strategy with 5 parameters might test thousands. The more combinations you test and select from, the more likely your final result reflects chance rather than real edge. Here is something that should stop you completely. A strategy with enough free parameters can achieve a 100% win rate on any historical backtest. This is mathematical certainty, not an opinion. Method 2. Adding indicators onto the equity curve looks smooth. This is the most visual and most seductive form of curve fitting. Because the result looks so clean, you add an RSI filter. Fewer signals, but the ones that remain look better. The equity curve smooths out noticeably. You add a volume filter, even smoother. You add a volatility filter, better still. Each addition makes the historical curve more beautiful. But each filter you add is making the strategy more and more specific to the historical data. Each filter is another measurement taken from the past mannequin. When you have 5 or 6 filters working together, the historical performance looks extraordinary. But the strategy is now so tightly fitted to history that any change in market conditions will break it apart. When you have 5 or 6 filters all working together on historical data, the results look extraordinary. And that feeling, the feeling of having finally solved the market, is the most dangerous moment in strategy development. Because at that point, you stop questioning the strategy. You stop looking for weaknesses. You start thinking about position sizes. Remove the strategy from the optimization data, and suddenly what looked like a sophisticated system is just 5 indicators with no real logic connecting them. Method 3. Cherry picking the backtest period. This is the subtlest and most dangerous form of curve fitting, and it is almost impossible to detect without disciplined testing protocols. You run your strategy across 8 years of Euro-dollar data. The overall performance is poor. You tried 2018 to 2023, better results. You tried 2019 to 2024, much better results. You tell yourself, I have found the period where this strategy works best. I have identified the right market conditions. But what you actually found is the date range that best fits the parameters you already chose before you started looking. You did not select the market regime. You selected the data set that makes your existing parameters look correct. A study in the Journal of Financial Economics analyzed 315 trading strategies submitted over 10 years. After correcting for data mining bias, the average true edge of those strategies was approximately 0. A decade of development collectively curve fitted into nothing. Now I want to talk about something that makes this problem especially dangerous for retail Forex traders specifically. Most retail traders backtest on daily, 4-hour, or 1-hour data covering 3 to 5 years of history. In 3 to 5 years, the Euro-dollar market might have experienced 1 or 2 major regime changes at most. When you optimize on that limited history, your strategy learns those specific patterns. It memorizes how the 2022 high volatility environment moved. It memorizes the 2023 dollar cycle. But next year has not happened yet. And when it arrives with its own unique conditions, your strategy has no model for it. This is why strategies that produce exceptional 3-year backtest so often fail the moment year 4 begins. The strategy was not wrong about trading. It just trained on the wrong exam and then had to sit the real one with entirely different questions. Before I go deeper into the science and the solutions, I want to share something quickly. On my Telegram at FXS Austin, every week I share real trade setups from the live market. Real entries, real stops, real targets. Not selected in hindsight, not optimized after the fact. If you want to see what genuinely forward-tested trading looks like in practice, come join the community. It is completely free. Link is in the description below. Now let us get into the actual science of why this problem is so difficult to escape. The core statistical problem in backtesting is what researchers call degrees of freedom. Every rule you add to your strategy uses up a degree of freedom. You are spending a unit of the available explanatory power. If your strategy has 10 rules and you test it on 100 trades, each individual rule is supported by only 10 trades. Statisticians generally require a minimum of 30 independent observations per free parameter before results carry any meaningful weight. A strategy with 5 parameters needs at least 150 trades in out-of-sample data before the numbers mean anything at all. Most retail backtests produce 50 to 80 signals over a 3-year period. They are severely undersampled for the number of rules being tested. Consider what that actually means. A 5-parameter strategy tested on 80 historical trades cannot tell you whether the result is real or random. You need 150 trades just to start drawing conclusions. The backtest is telling you nothing. The second statistical trap is called in-sample bias. When you use the same historical data to both build your strategy and then test it, the test is mathematically invalid from the start. The strategy has, in effect, already seen the future because you chose its parameters based on outcomes that are now part of its own test. Imagine you were given an exam, shown every correct answer, adjusted all your responses to match, and then graded on the same exam. Your perfect score tells you nothing about whether you understand the subject. That is exactly what happens when you optimize and then backtest on the identical dataset. The solution to this is out-of-sample testing, and it is the single most important concept in all of strategy validation. Out-of-sample testing works by splitting your historical data into 2 completely separate sections before you begin any development. You use the first section, perhaps the first 4 years, to develop and fully optimize your strategy. Once development is complete, you run the strategy entirely unchanged on the second section, perhaps just the 5th year alone. This second section is data the strategy has never seen. It was not used during development at all. It is a genuine test on new information. If the strategy performs well in sample, but collapses out of sample, that is the clearest possible signal of curve fitting. If the strategy performs reasonably in both sections, not necessarily equally, but in the same direction, that is real evidence of genuine edge. The magnitude of the drop from in-sample to out-of-sample performance is itself informative. Some degradation is expected and normal. A total collapse is a red flag that cannot be ignored. Here is what most retail traders actually do after the backtest looks good. They go live immediately. No out-of-sample test, no validation whatsoever. The first live month is the very first time the strategy has touched data it did not train on. Beyond basic out-of-sample testing, there is a more rigorous method called walk-forward analysis. Walk-forward testing moves through time in rolling windows rather than using one fixed training and testing split. You optimize on the first 3 years of data, test on year 4, then move the window 1 year forward. Optimize on years 2 through 4. Test on year 5. Move forward again. Repeat this process until the entire available history has been covered. You are testing whether the strategy can consistently re-optimize itself and produce positive results on new unseen data, window after window. If the walk-forward results are consistently positive across multiple windows, you have strong evidence of genuine edge that persists through time. If the results are inconsistent, some windows positive, some negative, without any clear pattern, that is strong evidence that the original backtest was curve fit. Walk-forward analysis is more demanding than simple out-of-sample testing, but it gives you a substantially more reliable answer about whether the edge is real. It also reveals something critical: the strategy decay rate. How quickly does the optimal parameter set become suboptimal as the market evolves? A strategy with a fast decay rate requires frequent re-optimization just to remain relevant. That is a significant operational cost that most retail traders never factor into their planning. A strategy with a slow decay rate, whose optimal parameters remain stable across multiple years, is far more likely to reflect something structurally real about how the market behaves. Together, out-of-sample testing and walk-forward analysis give you the most complete picture available of whether your strategy can genuinely survive in a live trading environment. Let me now talk about what genuinely robust strategy performance actually looks like in practice. A robust strategy is one whose performance does not change dramatically when you slightly adjust its parameters. If your strategy works well with a 20-period moving average, but collapses with a 19 or 21-period version, that fragility is a serious warning sign. A real edge in the market should produce broadly similar results across a range of similar parameters, not just at one single exact setting. If performance only peaks at one precise combination, you are looking at coincidence, not edge. This is called parameter stability, and it is one of the clearest indicators that a strategy has found something real rather than something accidental. The way to measure parameter stability is to plot what researchers call a sensitivity surface. You test all parameter combinations near your chosen values, not just the ones you selected, but all the nearby variations in every direction. A sharp spike in the sensitivity surface, where performance is excellent at one exact combination and collapses on all nearby ones, tells you the strategy only works at that one accidental setting. A gradual hill, where performance rises and falls slowly across a range of nearby parameters, tells you the strategy is genuinely robust and worth testing further. The difference between a sharp spike and a gradual hill is the difference between a strategy you should abandon immediately and one that deserves serious further investigation. There is a third validation technique that is particularly powerful for retail traders: Monte Carlo simulation. Monte Carlo takes your backtest trades and randomly shuffles them into thousands of different possible sequences to reveal what your real risk profile looks like. If your strategy produced 80 trades in the backtest, Monte Carlo creates thousands of different versions of your trading history using the same 80 trades arranged in different orders. It then calculates the full distribution of possible outcomes, from the most favorable sequence of trades to the most unfavorable. The key question Monte Carlo answers: given exactly the set of trades this strategy produced, what realistic range of drawdowns should I expect in live trading? Most traders are genuinely surprised the first time they run Monte Carlo on a strategy they felt confident about. Their backtest showed a maximum drawdown of 8%. Monte Carlo reveals that with the same trades in a different sequence, the drawdown could have reached 25% or more. That 8% drawdown was not a characteristic of the strategy. It was a characteristic of the specific lucky sequence in which those trades happened to occur during the backtest. Monte Carlo gives you a substantially more honest picture of the risk you are actually carrying. If even the pessimistic Monte Carlo scenario produces positive returns, you have strong evidence of genuine edge that survives randomness. If the pessimistic scenario shows account destruction, that is your answer. No historical result, no matter how impressive, justifies going live with that risk profile. Here's what most retail traders actually do after a backtest looks good. Go live. No out-of-sample test, no parameter stability check, no Monte Carlo, just the equity curve looked impressive. This is the direct path from curve fitting to account destruction. Now I want to give you a concrete, actionable framework for building strategies that can actually survive in live markets. Rule 1. Start with the hypothesis about why the market should move in a certain way. Not, I found a pattern that worked, but I believe price tends to do X because Y happens structurally and persistently. The why must come before any testing whatsoever. If you cannot articulate a structural reason for the edge to exist, you are data mining. Stop there. Rule 2. Write down every single parameter exactly before you run a single backtest. Define your periods, your thresholds, your filters, your trade management rules, everything before results exist. If you define any parameter after seeing results, curve fitting is guaranteed. No exceptions. Rule 3. Decide which data is training and which is testing before you open your backtesting software. Mark the testing data completely off limits. Do not look at it, do not test anything on it until strategy development is entirely finished. Rule 4. Test parameter stability before trusting any result. Change your best values by 10 to 20% in each direction and check whether performance shows a cliff or a gradual slope. Most traders never make it past Rule 2. They adjust parameters after seeing results, go live, and wonder why the backtest did not hold. The discipline to define everything in advance and never change it is exactly what separates the few who build durable strategies from the many who cycle through broken ones. Rule 5. Require a minimum of 200 in-sample trades and 50 out-of-sample trades. Below this threshold, the sample is too small to be meaningful, regardless of what the numbers show. Rule 6. Run a walk-forward analysis with at least 3 non-overlapping out-of-sample windows before considering any strategy validated. Rule 7. Run a Monte Carlo simulation and determine the realistic maximum drawdown range. Size your positions so that even the pessimistic scenario is survivable and does not cause you to abandon the strategy mid-test. Rule 8. Trade live at minimum position size for at least 90 days before scaling up. Your first 90 days of live trading is your true out-of-sample test. Nothing before that is final. Scale your position size only after 3 months of live results are broadly consistent with what your walk-forward analysis predicted. Before that threshold, you are still in the testing phase, regardless of how the live results look. Now I want to be honest with you about the hardest part of all of this. Everything I have described takes time. A proper strategy development process completed correctly with every step takes months, not days or weeks. During those months, you will face constant temptation to shortcut the process. You will find a backtest that looks exceptional and immediately want to go live. You will see the strategy missing trades during testing and want to start capturing them. You will second guess the out-of-sample results and want to adjust the parameters. Every single one of those impulses is curve fitting happening in real time. Every adjustment you make based on what you observe is another measurement taken from the past mannequin. The market does not reward the trader with the best historical result. It rewards the trader who built the most generally forward-looking model. I understand why this is uncomfortable to hear. The idea that a beautiful backtest might not mean anything is a difficult thing to accept. But understanding this deeply, truly internalizing it, is itself a genuine edge. Because almost no one in retail trading actually builds strategies this way. And that gap is real. If you want to see this approach applied in real time with real trade setups from the live market, come join my Telegram at FXS Austin. I post the full picture there, the setups that trigger, the setups that do not trigger, the misses, the losses, everything that happens on the live chart, documented in real time. It is not a highlight reel. It is the actual process of forward tested trading as it unfolds. Unfiltered. It is completely free. The link is in the description below. Come and see what the real process looks like. Now for the most important idea in this entire video. The goal of backtesting is not to build a strategy that perfectly explains the past. The goal is to find evidence, imperfect and incomplete evidence, that a strategy has a better than random chance of working in the future. That is a fundamentally different objective, and it requires a fundamentally different approach. A perfect backtest is almost always a warning sign, not a validation. Real edges are imperfect, inconsistent, and sometimes frustrating to measure properly. Real edges come from understanding something about market structure, participant behavior, or risk dynamics that is genuinely persistent over time and structurally grounded in how markets actually work. The tailor who makes a suit for the living future market rather than the past mannequin produces something that fits a little less perfectly, but it fits when the real client actually walks through the door. That is the strategy you want, not the one with the perfect backtest, the one that actually fits the real market when the real market arrives.